Okay, for this case study, we are going to look at a 70-year-old male and female. We're going to look at a couple here looking to allocate a significantly large amount of money to cash value life insurance policies. They have a number of goals, so let's touch on them here. We have a age 70 couple, male and female. Funding we're going to look at is as follows. So they are looking at $150,000 per year for a period of 5 years, and that's each. So you've got 150K policies. Really their total net number was to be able to allocate $300,000 per year for 5 years. So their plans are as follows. When allocating that large amount of money, because that's $1.5 million in total between both of them, they want cash value, safe, liquid, tax-free area to position funds. They are concerned about the cash value. They want to see that there. They don't necessarily need it, they've expressed, but in the event they want it, if they want to pull out money and gift it to their family or to anyone, they've got the ability to do that. If they want it for real estate or any other ventures that come up, they want that access. So they want access to the cash value. They don't need it, but they want it. It's their money. They've built it up over time. So safe, liquid, tax-free area to position money. Then we also have an asset transfer and estate planning. So here, the death benefit, or leaving a legacy, we could call it, does have a play. They're interested in that. But at the same time, they want to maximize cash value. So how do we get one the best of all worlds? Because it is possible. We don't want to say, hey, it's one or the other. You can either have maximum cash value, but then your death benefit's going to suffer, or maximum death benefit and your cash value will suffer. Not necessarily the case if you design a policy properly. So when it comes to the policy design, the older we get, the more important this is. Where can our money go? One of two areas. Let's use the total number of $300,000 per year. 10% is often the lowest we can drive the minimum premium. Sometimes lower. Actually, with this example, it's about 9%. But you'll see among the top companies in the industry, you can often drive that minimum base premium very close to 10%. This is where we always refer to that 10/90 split. So what that would mean is if I have a total payment of $300,000 per year going into the policy, that would represent $30,000 going toward the base premium and $270,000 directed toward PUAs. Now, it will not be that clean because we do have a term insurance rider attached as well, which is not nearly as expensive as one would think. We're going to get into that more in the next case study on a 75-year-old individual, actually showing the term costs, but it's not that high. However, we still want full disclosure there. So what we're going to look at here is different product options, but here's the main thing I want to touch on is MEC limit first. I want the minimum death benefit possible to obtain that 300K MEC limit. But then what product do I use? Because their concern is cash value. They want to see it there. But it's really estate planning, transferring assets. How do I minimize those insurance expenses as much as possible? So what we looked at here were two single life products. What does it look like? 150K each. And then with the 300K for 5 years, we actually took one policy. It's called a survivorship policy on two individuals. So on a husband and a wife. In this case, it's on the couple. One policy with $300,000 per year going into it for 5 years. So, couple quick notes on survivorship policies. We want to be aware of the pros and cons like any product is. It is one policy on both the husband and wife. If any of the individuals die, so if the husband dies or the wife dies, the death benefit is not paid out. Death benefit proceeds on survivorship policies are paid out after both individuals die. So it's really designed for the next generation. Some companies use them as well. And the reason why kind of leads into the next point. So that's the disadvantage. The death benefit dies after both people die. Or I'm sorry, the death benefit's paid out after both people die. The other piece is the cash value. So an advantage. Every situation is different, and you're going to see that here. But the advantage is because the death benefit's not paid out until both people die, this will result in a lower overall COI, cost of insurance. The insurance company knows that there is a good chance they're going to get to hold on to the death benefit claim for a longer period of time because both people have to die before they pay out the claim. As a result, you'll often find that the underlying insurance expenses are much less, which allows us to beef up the cash value. Now, a technical detail here has to do with the MEC testing. You do not have the same 7-pay test with the survivorship policy that one has with a single life policy. So often we'll talk about that reduced paid up option when we chop the premium off after the first 7 years. You can't do that with a survivorship policy in most cases, meaning we have to keep that death benefit high. So the thing is, rather than just say one's better than the other and look at that, let's look at both. So here we go. On the left, we've got the two single life policies. So we have an age 70 male, 150 for 5 years, total of $750,000, breaking even between years 4 and 5. Death benefits on oddball number, $1,540,000. Where we came up with that? Minimum death benefit possible in order to obtain a MEC limit of, guess what? $150,000. And then we have a 70-year-old female. Death benefits $1.65 million. So why is hers higher? Well, the quick answer is that it obtains a MEC limit of the same 150, but still, why is the death benefit higher on a female compared to a male? The reason why is females live longer, an average of 7 years longer. So based off the mortality tables, because they're going to live longer, a higher death benefit obtains the same MEC limit. Here's another way to put it. A 70-year-old female would actually have an equivalent to a 63-year-old male. Meaning a 63-year-old male, you need almost the same 1.65 death benefit. Numbers would look very similar. It's about a 7-year difference there. Overall, if we're both 70, you'll see a little bit stronger cash value here, breaking even just about year 4. If we look at the two over time, let's look at age 90, 1.27 with the male, 1.34 with the female. A little bit more death benefit as well. And then we have the combined values here. So it's always good to do this when we're comparing and contrasting with a survivorship policy or any scenario. What's it look like when I combine the values? And I, the agent, the person working with you, want to do it for you. Not here you go, do everything on your own. No, 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 right? We want the white glove service in any situation. So we want to do it for them if we're in the business. There's our cash value and death benefit. So that's the legacy with these two policies combined. Here is after year 7, that death benefit drop. What we did here was chop the base premium off, cut the term rider, went with a reduced paid up option. And what this specifically does is eliminate the premium, improves cash value performance, but initially sacrifices the death benefit a bit to do so. Okay. Now, as we look at the survivorship policies, we're going to get rid of this one in a second here. So this shows $300,000 for 5 years. Why we're going to get rid of it is initially it looks good, breaks even year 4, stronger out of the gates. As time passes, what happens to our cash value? Look at it. 2.1, 2.2, 3, 4, starts to come down quite rapidly. And why we have this highlighted here is, one, you see the product call for additional premium. We're 98, so one might say, who cares? But at the same time, if we're still around, we don't want to get this at 98. What's happening is the expenses, because we had to keep a term rider on all this time, which was way higher than I like, began to eat into the cash value performance. And what's highlighted in here, because that death benefit drops, it actually triggered a MEC. Ruined everything. So what we did as an alternative was reduce the insurance expenses and spread the payments out over 6 years. I wanted a clean comparison, and I want to make the survivorship policy as strong as possible. So we want to make everything apples to apples and optimize all policies here. So here we go. Single life policies on the left, the ones we had looked at. Joint life policy, the good one, $250K for 6 years. Had to spread the payments out over 6 years. Death benefit, $3.5 million. Survivorship policy, some companies do this where they pay an enhanced death benefit if both individuals die during the first 4 years. Has to do with the estate taxes and how they work. If you've got a CPA or an attorney, they can certainly provide more info on that. Or if you're working with us, we can. $3.5 million death benefit until this term naturally falls off. But here's the advantage. Look at this. Breaking even year 4 for a 70-year-old couple. That's attractive. Paid in for 6 years. Cash value continues to grow. Through year 7 here, we've got more money. If we look at the combined cash value. Beyond that, actually. But what happens at year 7 with the single life policies? That reduced paid up option. Death benefit is reduced. With the survivorship policy, could we reduce the death benefit? No, because we would trigger that modified endowment contract and have to deal with taxes. So what happens is the survivorship policy is stronger for a period of time. As we scroll down, what do we see here? Up until about age 90. So this is where it's kind of a personal decision as well. That's when the two single life policies combined overtake the survivorship in terms of cash value. A lot of people we work with might say, hey, myself included, I take more money up front because I can use it more up front for opportunities as they arise. However, if I'm retired in my 70s, could be a completely different mindset and say, okay, I'm very interested in the long term because I might not use it, but I'm particularly interested, Steve, in the death benefit. A survivorship policy will typically give one the best bang for their buck, call it, on death benefit proceeds. So here we go. All the way through, that 3.5 is higher than what we get with the two single life policies combined. All the way through age 100, 99, doesn't matter. Survivorship policy starts to appreciate at that point in time. Now, you could also look at the single life policies and say, okay, well, if I'm 70 and I die at 82, a death benefit of $1.2 million is paid to my spouse. Perhaps that is more valuable to me than the next generation. So these are the kind of things we want to talk through, see exactly what our goals are, or if you know your goals, say, hey, here are my goals. I want to see these options, lay them out side by side, or this guy's the way to go, or this one's the way to go. But if you're in a situation where you want to see the stuff up front and talk through it, we can certainly do that. If you don't want to talk through it, if you just want to see the numbers and then go through the main bullet points, we can do that as well. But hopefully you enjoyed this case study. It's really interesting when you start to look at individuals above the age of 60, in this case age 70, where so often we'll hear, I'm too old for life insurance, right? It can't work at my age. I wish I would have started earlier. Which is really not the case from the numbers we saw. If a policy is designed properly, that is the key there, designing it properly, we put ourselves in a position where we can reduce the insurance expenses and maximize the cash value. So going back to those examples, actually, if we look at all of them, you will see on the male and female here, a base premium of just over $13,000. It's about $13,500, about 9%, 9.1 to be precise. Same thing here, $13,500. Have a term rider attached as well, so the true expenses come out close to 10%, everything else in the PUAs. Over here, $250,000 going in, minimum premium. What happens with base premium dollars? If you've not seen any of our basic design content, in the first year, does that show up in cash value? No. The company overcharges me for the cost of insurance or death benefit up front. Beginning year 2, as if I look at the policy, so year 1, $250 goes in, that base premium of about $23K does not show up in cash value right off the bat. However, year 2, I pay in $250, see almost all of that come back, and then more and more each year. So the second year with these products, sometimes it is the first and second year, the second year with these products, our premium comes back to cash value. Sometimes with products, the company will overcharge me for the base premium in the first and second year, meaning the third year, that minimum premium will start to come back to cash value. That is the main deterrent from whole life insurance, in my opinion. Why people don't do it is typically they look at their cash value, it's their money going into a product. There's certain benefits of whole life insurance, maximizing the cash value and such, but what's the hit upfront and long term? How do I minimize that? Just like banks and corporations, they want to optimize their cash value right off the bat, and it's exactly what they do. And that also yields stronger long-term cash value as well. So, hope you enjoyed this case study. If you have any questions at all, reach out anytime, and we'll talk to you soon. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.